Are you aware of the recent buzz surrounding SoFi Technologies' first quarter earnings report? It seems like people have mixed feelings about it. SoFi is currently trading at $4.90 per share, and the company's shares took a significant hit recently, dropping by more than 12% after the report was released. This one-stop-shop financial services provider and digital bank has had a rough time lately. But what exactly happened during the first quarter? And what's in store for SoFi's future? SoFi made more than $472 million in revenue, beating earnings estimates. However, the company did report a loss of 5 cents per share. Despite this, they still managed to generate almost $75.7 million in adjusted earnings before interest, taxes, depreciation, and amortization. Most of the adjusted revenue, around $325 million, came from their lending segment. This was largely due to the $3 billion in personal loan originations. On the other hand, SoFi's tech segment didn't do as well, with revenue falling to around $78 million. And this was due to decreased accounts on their payments platform Galileo. SoFi's financial services division saw a decrease in losses, dropping to around $24 million in Q1 from the previous quarter's loss of nearly $44 million. In addition, the company has revised its full-year forecast for 2023, expecting to generate adjusted revenue of $2.02 billion and adjusted EBITDA of $288 million at the high end of the range. However, the management remains optimistic about achieving profitability by Q4 of this year. As per analyst David Moadel, there are a few reasons why SoFi stock could double up easily from its current position. Moadel thinks SoFi Technologies stock is worth considering even if banks make you nervous. Don't confuse SoFi Technologies with other financial sector companies that failed in 2023. SoFi is expanding its lending services, which could lead to significant profits. SoFi understands why people might be hesitant to invest in bank stocks. The media has been talking about Silicon Valley's bank and Signature Bank's failure, which can be concerning. However, Moadel thinks SoFi is different because they are changing their business model and moving away from riskier banks. This means that now could be a great chance for you to invest in SoFi while the price is low and others are fearful. Moadel believes that SoFi stock took a hit in March due to fears about banking crisis contagion. However, there is still a chance to buy SoFi Technologies shares at a low price of less than $7 each. The target is $22, which was the resistance level in 2021. So, if you're more cautious, you can aim for a 2x move, which isn't too much to ask. SoFi Technologies isn't a bank that took on too much risk with government bonds or cryptocurrency. Additionally, SoFi has made it clear that it doesn't hold any assets with Silicon Valley Bank. SoFi Technologies' unique business model sets it apart from other banks, and they offer various financial services such as app-based saving and investing, credit cards, loans, and financial planning. They recently expanded their loan services by acquiring Windham Capital Mortgage, which is a digital mortgage lender. This acquisition gives SoFi access to Windham's intelligent and scalable platform that offers a fully digital mortgage experience. With this new addition, SoFi can cater to young first-time home buyers, potentially bringing in significant revenue. SoFi Technologies has stepped into the world of mortgage lending, and this move could cause SoFi stock to soar twice as high. And despite this promising news, some skeptics still compare SoFi to Silicon Valley Bank and Signature Bank. However, here's a proof that SoFi Technologies is not the same as those banks that crashed in March. SoFi now provides customers up to $2 million worth of Federal Deposit Insurance Corporation or FDIC insurance per account, which is much more than the standard industry coverage of $250,000. So, if you have a lot of money with SoFi, you might feel better about their recent decision, but it's important to think about what it means. SoFi is trying to avoid the mistakes of other banks that couldn't cover deposits that weren't insured. The CEO, Anthony Noto, says they want to make sure their members aren't worried about their money. If younger generations feel confident about putting their money with SoFi, they might stick around and keep bringing in money for a long time. For almost 3 decades, equity expert Eric Fry has been closely observing the market and identifying 41 different stocks that climbed over 1,000% on his recommendation. But now, he's got his eyes on a spot that's over 2,000 miles away from Silicon Valley, which is a place that he thinks could be the next big surprise in the tech industry for 2023. According to Eric, some of the biggest companies on the Fortune 500 list are all set to invest more than $500 billion in this. This means that a substantial amount of investment could potentially flow into the 28 companies clustered in this spot. These companies have a competitive edge that gives them the potential to grow 10 times their current size, and SoFi Technologies is making a clever move by diversifying its business model. Additionally, it's gaining customers' trust by offering extended FDIC deposit insurance, which is a sign of being responsible and trustworthy. But before we continue, we want to thank you for watching this far. But let's now talk about what other experts think of SoFi. Moreover, more experts believe that SoFi stock has the potential to increase twofold by the year 2025. Experts believe that time is crucial for the success of SoFi stock. However, it might take around 1 to 2 years for it to return to its initial trading price of $22.65 per share in June 2021. SoFi stock currently trades at around $5, but it's essential to understand where it all began. SoFi became public after being acquired by social capital Sophia Corporation, which was one of the few special-purpose acquisition companies initiated by Chamath Palihapitiya. Today, SoFi's business vastly differs from the bank Palihapitiya took public. Now, SoFi released its earnings report, and even though it surpassed the earnings estimates and increased guidance, there are some reasons why the stock dropped. As we mentioned earlier, one reason is that Galileo's accounts declined, which hadn't happened before during the first quarter. Another reason is that the management didn't raise guidance significantly. Additionally, despite most SoFi's loans being designated for sale, the company continued accumulating on-balance sheet loan balances. The company's management clarified that they didn't sell any loans in their personal lending portfolio. However, they did engage in a $440 million asset-backed securitization during the quarter. This move may have caused some investors to worry about the company's potential to unload these loans down the line. The good news from the quarter was that the financial services department's loss decreased, but there are still worries about selling loans. SoFi's stock is also too pricey for some experts, with a current trading value of almost 18 times 2023 adjusted EBITDA. So, what do you think of SoFi's first quarter results, and what are you looking forward to for the next one? Share your thoughts with us in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons as well. Now, if you want to know more about what services SoFi Technologies is offering, then make sure to click and watch this video right here and enjoy. And that's the end of this video, guys. See you next time.